if you zoom out again, and we've talked about this a bunch, like there is more tailwind behind crypto adoption than there has ever been in the history of our industry.
Alrighty, what is going on, everybody? Welcome back to another fundamental video breakdown. In today's video, we're going to do a very detailed and thorough analysis going over previous market cycles, pullbacks, things that had weighed on risk sentiment before in previous years. And then that is going to allow us to really gauge the forward-looking trajectory of where the market could possibly head in coming weeks, especially considering the recent FOMC release and Fed speakers that we got last week, Jerome Powell's commentary, breaking all that down, and just taking a really in-depth look in the fundamental factors that have been driving either demand or sell pressure for risk assets like crypto to really give us a realistic analysis on where the market is headed in real time. So we're going to break that down thoroughly for you guys today. I'm going to go over the landscape, talk about what created some of these pullbacks in previous cycles. I want to really get you guys to understand that we are still in a headline-driven environment. We are not in some utility-driven super cycle yet, albeit I believe that we are entering into one. We are still in an environment where headline fundamentals, risk on, risk off sentiment are key drivers of price fluctuations in crypto. And I want to show you guys that because I firmly believe, at least this is again my personal opinion based on the current sentiment, that we are possibly set to experience some type of pullback, whether it's the yen carry trade unwind or whether it's inflation coming out slightly upbeat or higher, or hawkish Fed commentary, or just jobs market data that doesn't come out as weak as previously anticipated. Something is looming, in my personal opinion, and we know that markets can't go up for forever. Now, I hope that I'm wrong, and I hope that we do see another leg higher, and I hope that the fundamental landscape just continues to support a risk-on sentiment, and that I'm completely wrong, and we just see higher prices from here. But in case we don't, I want our team and our community to be prepared for what's next in case that does not materialize. So we're going to go over that. You guys are going to fully understand that landscape today. I've typed out a full report, risk on, risk off scenarios that could unfold this upcoming week, what we need to pay attention to heading into this upcoming week, the data, the insights, the Fed speakers, everything we're going to touch on in today's video. But before we do that, so that way you guys don't think that I'm bearish, because today's video, if you're watching this as a recording, could leave a bearish taste in your mouth via my perspective. I want you to understand that every single pullback that we've experienced since 2022 has resulted in another leg higher. And I firmly believe that we are still in that environment where even if we do enter into some type of pullback scenario, a risk-off induced environment, depending on how the fundamentals unfold in the coming weeks and months, it should be seen as an opportunity. It should be seen as, again, this is my personal opinion, not financial advice, an opportunity to reposition into discounted prices on blue chip altcoins that are likely to perform well in the long term as this market continues to mature and has never seen a bullish environment like the one in which we are operating in today. The regulatory landscape is clearing. Political support from governments and jurisdictions, countries all over the world are supporting the adoption of crypto and Web3. We're seeing legislation sign into fruition. We're seeing institutional interest at an all-time high. We're seeing DeFi activity and yield generation primitives pick up substantially. Like, there's never been a more bullish environment for crypto. However, right now that's not reflected in price. So we need to understand that in the short term, we could still experience some downside risk. However, again, like I said, I hope that that's not to be the case, but you guys will understand what those downside risks consist of in today's video breakdown. So to set the tone for that, to understand that I'm long-term bullish, just listen to this gentleman here speak real fast. I don't remember exactly where he stems from. I believe he is some CEO of some head protocol that exists out there in the space. Excuse my ignorance. I forgot to gather his credentials, but he was on this podcast the other day, and I completely agree with what he said here. So just take a second and listen to what he says.
I think if you zoom out again, and we've talked about this a bunch, like there is more tailwind behind crypto adoption than there has ever been in the history of our industry. There is the Genius Act, there is Clarity Act, and some sort of reconciliation. I was at a fundraiser for a senator a month ago who said, I will guarantee that we will get some sort of Clarity Act reconciliation done in October. Now, that's a politician, and I don't know if that's actually true, but this person was willing to put their reputation at this fundraiser on the line, right? There's, at this time right now, more Fortune 500 and more institutions, more businesses building on blockchain rails than ever before. There are more of these people that have RFPs out to integrate blockchains and crypto and stablecoins in their businesses than ever before. Like, these things are happening. Like, it is not as if we can just, like, I think just to put it to the side and act as if it's 21 all over again, because it's not. You're actually seeing real economic flow exist on chain, right? And so I really struggle with a lot of this, like, oh, this is the last time you'll ever be able to sell 115, because I mean, clearly, people who say things like that are really, it's about just pandering to an audience, right? And like continuing to increase, the amount of engagement. But it's, when I look at this from the outside in, it's hard for me to say anything other than we are getting what we want, right? And I think there was a title of a podcast that Santi and I did earlier in the summer that said, it's a bull market, just not the one you want. And it seems like that still is true, right? It is a bull market, just not the one people want. And so, it's funny, to your point, like I was on the...
So I'll leave it there, right? And so the reason why I want to go over the fundamental backdrop today in detail is because there's so many retail investors out there that I believe if we were to see a substantial pullback caused by some fundamental backdrop that creates a temporary risk-off environment, a lot of people are going to misgauge a pullback from a bear market cycle, right? I personally don't believe that we're going to enter into some elongated bear market cycle for quite some time, considering that for the first time ever, we are entering into an era where institutional adoption is ready to participate at scale. I don't see us entering into some prolonged year-long, two-year-long cycle like in previous cycles before, but I do understand the macro backdrop can create a temporary risk-off environment. I would like for you guys to understand that as well. So with that being said, before we get into last week and touch on what took place, let's just take a look back at previous market cycles, taking a look into these deep retracements in the total cryptocurrency market cap. So that way we're not biased against any one particular asset. We're just looking at the total market cap as a whole. I have some fundamentals slapped on the charts here for you guys to show you all what created a risk on and risk off environment in previous cycles. So that way we can again gauge what could possibly happen moving forward, and then also some of the risks to the downside that still exist in the total in the current landscape. All right. So if we go back to March 2024, and we've done this sometimes before in previous Zoom calls, so I apologize if this is regurgitated information if you're a CYPRX OG and you've seen us do this before. But let's really truly understand why this pullback happened, why these pumps happened. One of these pumps here in this area, back at the beginning of 2024, at the end of 2024, were primarily driven by the markets aggressively pricing in rate cuts from the Federal Reserve, a lower interest rate environment, and easy monetary policy. However, fundamentals at the beginning of 2024 completely changed that sentiment, and the market had to reprice that information in and dial back the aggressive risk-on environment that it was currently attached to, right? And so we can see this in the form of fundamentals. This is one of the first ones. You can see this is back from when we got in March, the February CPI report. Here it says what the experts are saying about the inflationary report. And it says, a data-dependent Federal Reserve is likely to push back the timing of its first interest rate cut after Tuesday's release of the February Consumer Price Index. Remember that the inflation data, labor market data lags. So the information that we got for February, we didn't get until March, but it's February's data. The Bureau of Labor Statistics said Tuesday, although that matched economists' forecast, it represented an uptick in prices from the 0.3% rate seen in January on the annual basis, and headline inflation increased to 3.2% versus the 3.1% reading a month ago. And that started to weigh on the odds and the likelihood that the Fed was going to cut rates, which is why we saw this aggressive move early on at the beginning of 2024. If we come over here, the next massive and substantial drop in price that we got was primarily driven by, again, fundamental factors, the markets pricing out the likelihood of rate cut probabilities. Here you can see this is from April 6, 2024, and it says, Federal Reserve Chairman Jerome Powell gave yet another speech and contributed to more confusion. That is a bad vocabulary word for risk assets. Remember, confusion, uncertainty, the markets don't like that. A more confusion on the outlook for interest rate cuts. Neil Kashkari, so a Fed speaker, president of the Minneapolis Fed, told Pension and Investments on Thursday that after suggesting 2 rate cuts this year, at the last Federal Open Market Committee meeting on March 19th through the 20th, he may start thinking about whether any cut at all was needed unless there is an improvement on inflation. So these were commentaries and rhetoric, hawkish rhetoric from Fed speakers that push back on the likelihood of rate cut probabilities. And we can see during the month of April how that price action was reflected. We saw outflows of risk assets, markets favoring most likely dollar and other safe haven assets, and the market was starting this pullback scenario. To continue, everybody thought that the rally was over or that the pullback was over. The market was going to flip back bullish again, but then yet again, headline fundamentals came out, suppressing risk appetite, pushing back on the rate cut trajectory, markets repricing that in, favoring safe haven assets like dollar, gold, yen, and weighing on risk assets like crypto. Here you can see it even says US dollar jumps after strong US jobs reports. And right here in the data, it says the surge in non-farm payrolls triggered a dollar jump across the board while risk appetite deteriorated. So a stronger jobs data report pushed back on the likelihood of continued rate cuts from the Fed. And that decreased risk appetite. Larger investors than you and I de-risked. You can see here, this is the month of June. They favored safe haven assets like dollar temporarily. Risk assets discounted. Buyers attempted to make an attempt to defend, but then rolling over into the end of July, beginning of August, does anybody remember in this area, this is the last fundamental backdrop that created the substantiating decline in prices, what happened here? Does anybody remember end of July, beginning of August last year?
Yen.
Yep, yen carry trade unwind, right? Which is a catalyst that for some odd reason, a lot of influencers on the internet think is going to be bullish for crypto. Inversely, it is my personal opinion that it is actually going to be terrible for risk assets. And I'll show you guys in terms of fundamentals why that is. So you can see here, this is from this year, August 5th, 2025, but it's remembering what happened a year ago. So it says 1 year ago today, the markets were rattled by the unwind of the yen carry trade as Japan shifted towards a tighter monetary policy and bond yields rose. The strategy of borrowing in low interest rate currencies like the yen to buy higher yielding assets became less attractive. So what did investors do? They sold higher yielding assets like crypto and stocks, and they started to aggressively buy into the Japanese yen, covering carry trades. This led to the carry trade unwind. At the same exact time, the first week of August, we had a horrible misprint in the NFP, and that created over a $700 billion outflow in risk assets. Now, to again support my thesis, these pullbacks, whether it be they last a month, whether it be they last 6 months, like the last one did here in this area, will find support and the upwards trajectory will continue as the underlying fundamentals in crypto are bullish. So this is why I'm trying to continue to tell you guys, if we do experience some type of drawdown or pullback scenario, it is not that we are entering in some bear market cycle. It is a repositioning, rekindling of orders. Market will find support and the underlying fundamentals in crypto will prevail, and we will likely see institutions defend at discounted prices and pump the markets higher. As we continue, rolling into August, September, October of 2024, that is when we finally got the interest rate cuts from the Federal Reserve. Now, unlike this most recent time, why did we see an aggressive leg higher? Not only did we see optimism because of Trump winning the presidential election and him favoring crypto policy moving forward, but the markets continued to aggressively price in that heading into 2025, the Fed was going to be able to continue to cut rates. However, at the December 18th, 2024 meeting, that whole entire anticipation was corrected via one FOMC meeting. You can see here. This is from December 18th, 2024. The FOMC's hawkish cut slams risk appetite. So even though the Fed came out and cut interest rates by 25 basis points in December 2024, the market was expecting a euphoric rally after that took place. Jerome Powell came out and pretty much said, hey, look, we're still seeing an uptick in inflation. The data does not support further easing. And so we are going to put continued easing on a pause, and that dialed back rate cut trajectories heading into 2025. And we started to see outflows of risk assets and the market reposition itself. Same thing, similarly to what we saw, excuse me, at the beginning of 2024. It was literally driven by the same scenario. Markets aggressively priced in rate cuts. The rate cut optimism, coupled with a couple other fundamental factors, was deteriorated and made risk assets less appealing. Eventually, risk assets found support and continued to trail higher. Same thing happened end of 2024, rolling into 2025. The next major catalyst you can see here was in January 2025. What happened? Well, same thing like what happened at the beginning of 2024. Jobs data pushed back and supported a more hawkish Fed rhetoric. You can see here, this report reads, U.S. jobs report heightens chances of an extended Fed pause that is bad for risk assets. This provided a clear backing for no change in interest rate decisions from the Federal Reserve later this month. The U.S. jobs report shows payroll rose by 256,000 in December versus 165,000 consensus figure. The revisions to the past 2 months were negative 8K. The unemployment rate has fallen to 4.1% from 4.2%. The consensus was for it to hold at 4.2%, with the risk skewed towards a 4.3% outcome. So this shows that the US labor market data came out much more resilient and stronger than what the market was anticipating. And this pushed back on the notion that the Fed was going to be able to continue to cut rates early on in 2025 and continue to deteriorate market sentiment. As we progress, all right? So heading into February 2025, before I tell you guys what took place, does anybody remember what substantial fundamental events? There was two of them, two historical things that happened in crypto that completely deteriorated the market sentiment. And this is, of course, outside of all the ongoing tariff rhetoric that we had at the beginning of the year, January through April 2025, which I did not cover in this fundamental backdrop, but that we know existed. We had Trump tariffs announcements all through the beginning of 2025 up until about April 7th, weighing on market uncertainty and risk sentiment. Favoring safe haven demand, we started to see Trump announce tariffs on all jurisdictions. We had that back and forth rhetoric between the EU, Canada, Mexico, China, all these major jurisdictions, India, so on and so forth. That created market uncertainty. But outside of that, what two major things in February continued to deteriorate market sentiment? I have the two fundamentals here, but can anybody tell me before I go over them? Does anybody remember?
I think there was some kind of hack that took place on
Beautiful.
a major exchange.
Right, good job. We had the largest hack in crypto history, and that was on February 21st, 2025, where North Korean hackers, likely the Lazarus Group, stole approximately $1.5 billion in ETH tokens from the crypto exchange Bybit. So that was one scenario. Good job. I didn't see the name that popped up, but good answer on you. I think that was Al, if I'm not mistaken. What was the second thing? It happened at the beginning of February 2025. Does anybody remember? Had something to do with the tariffs.
Imposed tariff on China 100%, no?
Yeah, well, long story short, whichever way you look at it, there was a tariff scare, right? And the tariff in the uncertain environment that the tariff induced fears were creating created massive liquidations in the crypto ecosystem and risk assets in general. So we had the biggest liquidation event in crypto history with over $2 billion wiped out in just 12 hours at the beginning of February. And this was primarily due to the US trade wars intensifying. Trump imposing tariffs on jurisdictions like Canada, Mexico, and China, and that sparked an aggressive risk-off induced environment, and again, favoring safe haven flows. And so these were just some of the events that took place in early 2025. Fast forward, we see here in April 2025, after the Liberation Day announcements on April 2nd, the market found a floor. So just like what happened in 2024, eventually after the pullback threshold induced environment eased, markets found support. You can see from where aggressive buyers had been coming in before. And we created another leg higher. Same thing, 2025, markets pulled back, corrected the over-induced sentiment from end of 2024, found support, and created another leg higher, right? So why did the market start to bottom out in April? I don't want to give you guys only the risk-off induced events, but at the beginning of April, you can see the dates, April 10th, April 10th, April 10th. We had CPI and PPI come out lower the first week of April for the first time in record months. And we had positive announcements with Trump coming out, easing some of the uncertainty around the tariff implications that previously existed at the beginning of 2025. You can see here, we would love to get a deal with China. I'm thinking that we will end up working on a deal. Then also some positive announcements from the EU. And then also we had the lower inflation. So all of that coupled and favored a more risk on environment. Investors started to flood back into risk assets, sell off safe haven assets, particularly like the dollar, and continued to start to price in easing monetary policy and a more favorable environment surrounding the tariff implications that had previously weighed on risk assets. Now, this little tiny blip pullback right here, okay, this was between May all the way through June. Does anybody remember before I enlarged this fundamental piece, what was the primary driver of this little tiny pullback here between May, June, and July? Does anybody remember what massive geopolitical event happened here in this area?
Wasn't it Israel and Iran?
Sorry, one person at a time. Go ahead. Go ahead, Dan.
Was it Iran bombing?
Yeah, right. So it was just long story short, it was the Israel and Iran conflict, and it lasted 12 days. So you can see here. Over 150 distinct locations were targeted over the course of 12 days. It took place between the 13th to the 24th of June, 2025. And that was one of the primary factors as to why we saw this little tiny blippy pullback. Risk off environment, gold soared to new all-time highs, dollar strengthened, yen strengthened, i.e. safe haven assets, and it weighed on risk sentiment. However, same thing. Everybody that thought that this was when the bear market was going to happen, what happened? The market found a favorable in risk on environment eventually, found support from where aggressive buyers existed before, and the market continued to trail higher. Now, if we look at the underlying fundamentals as to how the sentiment changed, what took place, look at the dates on June 23rd, 2025, the exact time that the market bottomed out and created another leg higher. It says, Israel and Iran, U.S. president congratulates Iran and Israel on a truce deal, but neither country have confirmed an agreement to end the war. So we had optimism that a ceasefire was in place. And if you look at the dates, when this green candlestick turned around, it was Monday, the same exact time that Trump came out and announced a ceasefire, right? So this is clear. This is just a clear perspective for you guys to show you all that these risk-off induced events, i.e. pushback on rate cuts, hawkish Fed commentary, upbeat unemployment claims, higher inflation, any geopolitical tensions or tariff-related escalations that create confusion or market uncertainty, these are the things that weigh, at least right now, on market sentiment, right? Inversely, anything that supports rate cuts, dovish Fed rhetoric, easy monetary policy commentary, the fact that labor markets continuing to cool or deteriorate, inflation's coming out cooler, geopolitical uncertainty is easing, there's ceasefire agreements and trade talk announcements that come out positive leaning for jurisdictions involved and just create optimism in the market. That has been what is driving market sentiment higher, right? Creating risk on flows and outflows of safe haven assets. And so right now we are in this consolidation phase where you can clearly see that since about, I'd say from July 2025 up until where we're currently trading at now, September, long story short, price action has been consolidating. And so we are on the cusp, rolling into 2026, of either experiencing a continued leg higher or a market pullback like we have seen in previous cycles that last a few months, maybe a month, maybe two, maybe three, who knows? We don't have a crystal ball, but we do have fundamentals that we can analyze week by week that will give us the sentiment moving forward, right? And so this is what we're on the cusp of analyzing. Does the market favor risk on via the fundamentals that come out? Or do we see a risk-off induced environment heading into the end of the year, rolling into 2026, everybody thinking that we're in a bear market cycle? Oh my gosh, crypto's dead, blah, 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 like they did in previous times. But then the market just repositions itself, finds support. We reposition ourselves as well at discounted prices, and the market creates another leg higher. That's what I think personally going to happen in the near term, right? So let's cover that. Taking a look at last week, this is our September 19th, 2025 report before we roll into the forward-looking trajectory. of this upcoming week ahead. Last week, the total cryptocurrency market cap ended the week under pressure, slipping roughly $30 billion lower and once again failing to break and hold above the key $4 trillion level, despite the US Federal Reserve delivering a widely expected 25 basis point rate cut. How many influencers on the internet did you guys see say, oh my gosh, crypto's going to rally, Fed's cut 25 basis points, we're going to new all-time highs? I know you guys saw it because I sure did. That is unrealistic, and that's not how the markets work. The markets work off of expectations. They move, and the market makers move price based off of what they're pricing in advance. Chair Jerome Powell stressed a data-dependent approach, reminding markets that further easing will not follow a preset path. The Fed's updated dot plot still hints at a 2 additional 25 basis point cuts before the end of 2025, leaving the median 2025 policy rate at 3.50 to 3.75%. But a large minority of Fed officials, 9 out of 19, foresee only one or no additional cuts moving forward. Futures markets reflect this uncertainty. Traders continue to price in about a 90% chance of an October cut and an 80% chance of a December cut. I highlighted that in bold because that is going to play a key important role this upcoming week. Do these odds increase, supporting and favoring a risk-on mood, or do they decrease, strengthen the dollar, and favor a risk-off mood? Those probabilities are highly sensitive to upcoming data. For crypto traders and macro investors, this means that the next few weeks of economic releases will be pivotal. Powell's risk management cut language balanced softer labor trends against still elevated inflation and made clear that any upside surprise in jobs or prices could shift expectations and strengthen the US dollar, dampening risk appetite. Now, in this report, we also talk about the Bank of Japan and the possibility of an unwinding of the yen carry trade if the Bank of Japan does decide to hike rates, especially if they decided to hike rates more aggressively than what the market is currently prepared for or pricing in. So make sure that you guys go through and read this scenario as well. We're not going to thoroughly cover this in detail until the end of this when I cover and read this yen carry trade unwind threatening global markets report from August 17th, 2025. But we'll get to that. So taking a look at the week ahead. In the US, traders will closely monitor a series of appearances from Fed officials for further clues on policy plans for the rest of the year, including remarks from Fed Chair Jerome Powell at the Greater Providence Chamber of Commerce in 2025, which is set to take place, I believe, on Tuesday. On the data front, upcoming releases including personal income and spending data, featuring the Fed's preferred inflationary gauge, the PCE price index, alongside durable goods orders and the S&P Global Flash PMI survey. Economists expect August consumer spending and income to rise 0.5% and 0.3% respectively, for a third straight month of gains. Durable goods orders are projected to decline to 0.4%, a smaller drop than in previous 2 months. PMI readings are likely to confirm slowing private sector activity in September, and housing remains a weak spot, with existing and new home sales expected to fall to annualized rates of 3.98 million and 0.65 million respectively. Remember, I told you guys all these little tiny data and percentage points and all that bullcrap, you don't really need to understand. You just need to understand, is it going to create demand for the dollar, or is it going to weigh on the dollar strength and prop up and prop up risk asset appetite, right? As we continue, here's another report. Just talks about reading some of these highlights. The US dollar fell through the first part of last week, and lows for the year against several G10 currencies were set in the initial reaction to the rate cut by the FOMC. However, Chair Jerome Powell's press conference and look at the summary of economic projections were not as dovish the rate cut concerns about the deterioration of the labor market seem to suggest. So that is important. That's why I highlighted this in red, because we know in previous market cycles, less dovish rhetoric, more hawkish rhetoric from Fed speakers, including Jerome Powell, does what? It weighs on risk appetite. Now, we don't have a crystal ball, and we can't sit here and say that that's going to be confirmed, that it's going to weigh on risk appetite. But if it's happened in the past, it's likely to happen again, right? The past tends to repeat itself. So if Jerome Powell and Fed speakers this week come out more hawkish leaning, pushing back on rate cuts, and we've seen in 2 previous cycles, a pushback on rate cuts tends to lead to what? A pullback in risk assets. We know this consolidation if we saw that environment, would likely lead to a pullback or a retracement. So again, I'm just trying to give you guys some insights into how to play chess with these markets. To continue, it says the dollar remains most sensitive to changes in the U.S. interest rates, encouraged by the latest summary of economic projections. The market has a rate cut fully discounted for next month and about a 75% chance of a cut in December at the meeting as well. Yet the pendulum has swung quite far. And until at least the next jobs report, which is on October 3rd, it is hard to see the chance of a faster pace in rate cuts. As has often been the case, the market had one reaction to the Fed statement and another let me reread that. As has often been the case, the market had one reaction to the Fed statement and another to the Fed Chair Powell's press conference. In the next week ahead, nearly 3 out of 4 governors and regional presidents will speak. Keep in mind the wide disparation of views. Powell speaks on Tuesday. Then, obviously, of course, I always like to read the ING report. They're very transparent with what they think, and I really like their overall projections. They've been pretty damn accurate. One thing that they do say here in this report is that they are predicting 2 more cuts this year and 2 heading into 2026. So if this is what the market makers, i.e. people with a lot of money that move these markets, are pricing in, if this upcoming week that expectation changes, what do you think we're going to likely see? We're going to see more demand for the dollar, maybe even more demand for the yen, depending on the economic backdrop, and less demand for risk assets. Inversely, if we see the data support this thesis, 2 more rate cuts this year and 2 heading into 2026, and we see those odds increase, we see dollar weakness, and we see a more favorable environment for continued risk on sentiment, we're probably going to see assets like crypto continue to consolidate at these highs or continue to trail higher, while we see dollar continue to depreciate in value against other G10 currencies. So let's go over these scenarios real fast, so that way you guys thoroughly understand everything that we would ideally like to see for a rainbow scenario, to see October and December rate cuts alive and risk on environment supported. All right. And we'll go over these scenarios here on the total cryptocurrency market cap. And then I will leave you guys covering the possibility of the yen carry trade. And again, how everybody, for some odd reason on the internet, thinks that it's bullish for risk assets, particularly like XRP, speculating that XRP would solve some liquidity crisis when that's not guaranteed, nor has that been the case in historical events that took place last year. So, reading this thoroughly through, it says, what keeps October and December cuts alive? So this is ideally what we would like to see this week if we want to see this type of price action this week in the total cryptocurrency market cap. That means altcoins continuing to rally, Bitcoin continuing to trail higher, and the sentiment just continuing to improve. Consolidation moving sideways, no further deterioration or drop in price, and just stable buy pressure, but also sellers defending at highs, not creating an environment that's more favorable for risk assets. A drop in price down into discounted areas, i.e. last week's lows, buyers coming in, aggressively defending and creating another leg higher, or just creating another leg higher from where we currently stand, retesting the breakout, turning it as support, so making $4 trillion of support and continuing to trail higher into higher territory. I know that these are a little confusing, but you have a consolidation scenario, a drop into discounted prices from last week's lows, buyers defending and continuing to push price higher, or a breakout, retest and support scenario, and a continued move higher. If we want to see that type of price action this week, then we need to see these events. So to sustain a 90% chance of an October cut and a 75% chance of a rate cut in December, the incoming data must confirm softening in the US economy without sparking an inflation scare or recessionary fears. So core PCE, which is the Fed's preferred inflationary gauge. The ideal scenario that we would like to see this come out as, to again support a risk on environment, is we would like to see the data come out as the market is expecting, or a cooler print, month over month, coming out at 0.2% or below, an annual trend drifting towards 2%. So I believe right now the market is projecting a 3% reading a previous reading of 2.9%, we would like to see the data come out and the annual reading closer to 2%. So anything below 3% to 2.9%, trending down towards the 2% threshold. That would likely reassure that the Fed, that would likely reassure to the Fed that inflation is easing. Anything near or below consensus in the month over month at 0.2 to 0.3% would support the case for more cuts later on this year. So if you go over to the economic calendar here, you can see that the core PCE prices quarter over quarter, and then down here on Friday, the PCE price index month over month, looking at the consensus, looking at the previous, we would ideally like the figures to come out below the previous reading and below the consensus, showing signs of cooling in the inflation data. Second, we would like to see labor market softness, the initial jobless claims edging higher, or payroll growth slowing. That would validate Powell's risk management cut stance. A gradual rise in unemployment would strengthen easing bets. So if we come over and we look at the labor data that we're set to get on Thursday, you can see here it says jobless claims 4-week average. Right now, the previous reading is at 240,000. The forecast does show a slight increase, higher unemployment claims at 242,000. We would ideally like to see this figure come out slightly higher, maybe at like 245, 247. Anything lower than the previous reading will do the opposite or the inverse and will likely push back on rate cuts. Same thing here. We have the initial jobless claims as well. Spending and demand cooling without collapsing. So we have the personal income and personal spending figures this week. We'd ideally like them to come out at or below previous readings. That would indicate steady but slowing consumption, enough to ease price pressures but not trigger recessionary fears. So I wrote here, if this week's data shows that personal income and spending are growing more slowly than expected, markets will likely interpret it as confirmation that the economy is cooling and that the Fed can safely deliver the October and December rate cuts already priced in, keeping pressure on the US dollar and supporting risk assets. We also have PMI and durable goods. Ideally, we would like the PMI figures to come out at or below the 50 grade threshold, and durable goods declining as the market is projecting. The market's projecting a negative 0.4% reading. That would fit the narrative of slowing private sector activity and support the rate cut narrative. And then last but not least, we have the Fed speakers, multiple of them scattered throughout the week, particularly tomorrow and Tuesday. We would like the Fed speakers to come out in line with Powell's tone from the previous meeting or support the rate cut narrative. So if the many Fed speakers this week emphasize patience and a data-dependent stance, it will likely reinforce the idea that more cuts are probable but measured. Ideally, we would like them to commit comments that support the market pricing in higher probability of rate cuts. So saying things like the uptick that we see in inflation right now is a one-off event. We don't see it weighing on the rate cut trajectory. Labor market data is continuing to cool, which supports the rate cut narrative. Pretty much any commentary that supports the market's pricing in continued rate cuts is what we would ideally like to see. Anything that pushes back on that once we get into this scenario is likely to weigh on risk assets. So the net effect, if we can get all of these things, I call this a rainbow scenario. It's less likely to happen, but it is possible. We're going to most likely see the market keep October and December rate cuts priced in. We're probably going to see pressure on the US dollar, and we're likely to see support for risk assets. Now, again, just because we see the market continue to price in rate cut odds and favor a risk-on environment does not mean that we're just going to see the market rally higher. We could see an environment where price action just consolidates and we don't see any aggressive bulls or bears. We just continue to trail sideways. Inversely, what could weigh on rate cut odds? Pretty much flip everything that I just said on its head and do the inverse of it. So, sticky or reaccelerating inflation. If the core PCE comes out at or above market consensus month over month or year over year, that would likely change the inflation cooling story and it would push back on rate cut odds just like it has in previous cycles, like I showed you guys. Any hot labor market data, so jobless claims dropping sharply or wage growth reaccelerating, could signal that the labor market is not softening as much as the Fed had previously assumed. Any stronger than expected consumption and manufacturing figures, personal spending well above the 0.5% threshold, durable goods coming out positive, or PMIs coming out solely above the 50 grade threshold. That would hint at a resilient demand in the overall economic strength, and it would reignite risk asset price pressures. We'd likely see the market start to price out a high probability of rate cuts that would likely support the dollar and weigh on risk assets. And then most importantly, any hawkish Fed rhetoric. If Powell or other officials downplay the need for rate cuts, I put that in bold. So any comments that come out that downplay further rate cuts, or any of them express concern about inflation overshooting, the market odds for an October to December rate cut would likely fall. And then last but not least, I also put any hawkish Bank of Japan rhetoric or increased probability of rate hikes from the Bank of Japan, leading to strengthening of the yen. The net effect of all these outcomes is likely a reprice for fewer or delayed cuts, pushing US yields and the dollar higher, creating short-term headwinds for crypto and other risk assets. So just like we saw in previous cycles, we're likely to start to see a pullback scenario or an induced environment that is not favorable for risk assets. Now, I'm not saying that in one swift drop or decline in price is going to happen where overnight it's just going to look like this. No, but we're likely to not see any higher prices this week upcoming if we see these events, if we see this environment unfold. That we can know. So the bottom line is the key catalysts are going to be PCE report and the Fed speeches this week. Markets extremely sensitive with risk assets already pricing in aggressive easing. Even a small upside surprise in the data that pushes back on the market expectation that the Fed is going to continue to cut rates, which is exactly what the market is priced in, it's going to likely spark an outsized dollar rebound and weigh on risk sentiment. So any stronger data, which is not what the market's prepared for this week, the market's continuing to price in easing from the Fed. If we get any data that supports a stronger environment or economic data in the US, we're likely to see strength in the dollar come back to the table. A clean cooling but not collapsing data print would likely keep the path open for the crypto market to continue to rally above the $4 trillion breakout zone. However, any hot data risks a rejection of that $4 trillion threshold and a continued market correction. So here I have for you guys the scenarios drawn out with checklists so that way you guys can see them visually. And then inversely, of course, the opposite factors that would weigh on risk sentiment and the levels in which I'm paying attention to. So outside of that, very easily understandable to digest the information this week. It's going to be a very busy week. The economic calendar is packed almost every single day. Actually, every single day, pretty much. Tomorrow is really the only day with not a lot of scheduled data. Instead, we just have a bunch of scattered Fed speakers. So we're definitely going to be paying attention to the rhetoric and commentary. I'm going to continue to update you guys in the fundamental section on breaking news and headlines. This weekend has been relatively quiet. We did see some geopolitical headwinds this weekend that I mentioned to you guys in the chat down here in the fundamental section. We had some escalations between Israel and Gaza, and we also had some escalations with Russia, Ukraine. So we're still seeing a headline environment where the uncertainty and geopolitical tensions also plays a factor. This week, if we see any escalated tensions between tariffs or any geopolitical sentiment, increase demand for safe haven assets and create a more uncertain environment, that could also outweigh any positive data that we get supporting the rate cut narrative and create a shock to global risk assets. So for example, just to throw some scenarios out there, even if we were to see inflation data come out lower and labor market data come out showing signs of continued cooling, that's supporting risk asset sentiment. But then the Middle East comes out with some crazy ass announcement with the United States involvement, bombing, deaths, all kinds of crazy uncertainty. The market could obviously, of course, gravitate towards that, favor safe haven demand, and outweigh the pricing into the rate cuts and create a risk off environment. So just be mindful of that, right? That these geopolitical headwinds still play a major role in market sentiment, which is why I continue to update you guys on ongoing events. All right. Outside of that, the last thing that I want to read to you guys, this is not an immediate threat, but still something that we need to be mindful of moving forward. So this was a really good article. I'm not going to read the whole entire thing. I will drop the link right now in the chat for you guys so you can take some time to read it. It is from August of this year, so just a couple of weeks ago. But some key highlights from it is here. It goes on to say, it becomes a double-edged sword for the Japanese investors with dollar-based assets as they face not only the risk of currency strengthening, but also a reduced premium from their currency, hedges making their position less profitable. What this clearly suggests is that there's a very good chance that the USD JPY will begin to decline and strengthen against the dollar. There's also a good chance that if these rates all start to break, then the yen will break its major technical support level. It is difficult to determine the direct impact on US risk assets, as the relationship between the USD JPY and the NASDAQ 100 is not as strong as it was last summer. That's important. But generally speaking, a strong yen is associated with a risk-off sentiment. So you guys see that sentence right there. A strong yen is associated with a risk-off sentiment. The interest rate and currency market have not positioned themselves at these spots by chance. They have a level of importance, and after multiple visits to this region, the risk of a break rises each time. It is impossible to know what will trigger the unwind of this trade that has helped prop the USD JPY above 140 essentially since July 2023, but it appears that the end may be closer than most people think. So we're definitely going to be mindful and paying attention to the ongoing rhetoric between central banks. Now, another thing that I'm being mindful of is it says here, where is it at? I don't remember where it said, but it was talking about how, you know, oh, hold on, let me try and find it real quick for you guys. Where's the one where it's talking about Neil Kashkari? I might have closed out. Anyways, it was talking about how this economist was saying that the Bank of Japan is actually behind in their rate hike cycle. And so right now, the market is only preparing for a 25 basis point hike in October or the remainder of this year, even heading into 2026, because who knows when it's going to be. But if the Bank of Japan is behind on their rate hike cycle and the market's only preparing for a 25 basis point hike, but then the Bank of Japan comes out, surprises the market via what the market is expecting, and hikes by 50 basis points, what's likely to happen, right? Again, just a rhetorical question in your head. We already know what happened last year when the market was surprised with a rate hike via the Bank of Japan. Here in July 2024, the market was only expecting a 25 basis point hike by the Bank of Japan, and instead they surprised the market with the 50 basis point hike, and that led to over $700 billion of outflows in risk assets. Now, again, here in this community, we understood that temporary risk off flow. And so what did? We bought that dip. We positioned ourselves at discounted prices across the board. And now all of those positions are currently in profit to some degree, to some extent, especially if you were buying at those lows, right? So we will continue to favor that type of environment if we were to get that type of scenario. We just have to play it by ear, right? So just be mindful of that. Those are some of the risks moving forward, the environment that we would likely to see if we want to continue to see a leg higher in crypto this week. Inversely, if we see these fundamentals unfold, creating a risk-off environment as well. If you're a trader or you're a swing trader or somebody that wants to shave some profits off the top of your positions because they're substantially in profit, considering where you might have entered in before, If we were to see this type of environment unfold, could be a hint or a signal for you to start to do so. I'm personally not, because in my long-term investment portfolio, I'm not trading. I'm simply just investing. So I'm using market downturns, if we were to get this type of environment, to just dollar cost average in and build bigger positions to just hold for the long term and staking and yield generation strategies. All right. Outside of that, though, that's all that I have for you guys for today's fundamental backdrop. I will make sure to drop this September 21st scenario playlist in the chat for you guys so you have it for this week. Make sure that you guys read it so that way you understand it from your own perspective. Outside of that, though, that's all that I have for you guys today in terms of the fundamental backdrop. Hopefully, this painted a clear picture for you guys as to where we're at now, where we could possibly be headed in the near future, to paint a just realistic and humbling perspective for you guys. Outside of that, I'll leave the floor open for questions, general commentary, and I'll let you guys get back to your Sunday.